Welcome to FinTech Matrix, where tech meets money and trends become power. You heard it here first. Today is July 19, 2025, and we're unpacking the major moves shaping your financial world and redefining technology at the core of global commerce. First, U.S. lawmakers passed the landmark Genius Act, creating the first federal framework for stablecoins. Wall Street, crypto markets, and regulators are all responding, and the effects are immediate. Next, Apple, Visa, and Microsoft roll out next-gen tech that embeds finance into your daily life, from fraud protection to payroll wallets and AI-powered spreadsheets. Finally, we break down what these changes mean for you, the investor, the builder, or the strategist trying to stay one step ahead. So grab a cup of coffee, settle in, and let's unpack what matters to your wallet and your world over the last 48 hours here on FinTech Matrix. Let's start with what's moving the markets today. Here's your finance update. Genius Act becomes law, banks pivot, and JP Morgan sparks open banking battle. Let's start with what's driving financial markets across the US and globally. Regulation is reshaping crypto. Big banks are redrawing their battle lines, and institutions are accelerating the shift toward tokenized finance. In Washington, a historic step forward for digital assets. President Trump has signed the Genius Act into law, delivering the first comprehensive federal framework for stablecoins in U.S. history. The bill passed both chambers of Congress with bipartisan support, 308 to 122 in the House and 68 to 30 in the Senate, making it the most significant crypto legislation ever enacted at the federal level. Under the new law, only licensed banks, credit unions, or approved fintech issuers can create dollar-pegged stablecoins. Issuers must maintain full one-to-one reserves, undergo regular audits, and register with federal regulators, either the Office of the Comptroller of the Currency or the Federal Reserve, depending on their operational scope. The crypto market responded immediately. Bitcoin surged past $120,000 for the first time in its history. Ethereum climbed above $3,700, while altcoins like Solana and Avalanche posted double-digit gains. Total crypto market capitalization briefly crossed $4 trillion, signaling investor confidence that a regulated environment will attract large-scale institutional capital. Wall Street didn't wait. JP Morgan Chase announced it will expand its JP Morgan Coin platform beyond wholesale payments to include cross-border retail settlement. Goldman Sachs and Citigroup are preparing pilot rollouts for tokenized deposits, while stablecoin firms like Circle, Paxos, and Gemini confirm they are submitting applications to operate under the new framework. Retail giants are also joining the digital currency race. Both Amazon and Walmart are exploring the launch of their own internal stablecoins, not for speculation, but to streamline customer rewards, reduce transaction fees, and challenge traditional payment rails like Visa and MasterCard. However, the legislation is not without controversy. Multiple watchdog groups have raised concerns over financial disclosure exemptions within the bill, particularly those shielding executive branch interests. Reports allege that members of the Trump family may have indirect stakes in companies likely to benefit from the new law, raising questions of ethics and conflict of interest. Meanwhile, a second bill, the Clarity Act, is now awaiting a Senate vote. If passed, it will resolve long-standing jurisdictional confusion by defining whether a digital asset is a commodity or a security, and whether oversight belongs to the CFTC or the SEC. This would mark the final piece of regulatory clarity needed to unlock broader adoption of tokenized assets, DeFi products, and blockchain securities. In traditional banking, JP Morgan Chase made headlines this week by announcing it will begin charging access fees to fintech data aggregators like Plaid, Yodlee, and Finicity for using its APIs. The bank argues the fees are justified by its $18 billion annual tech spend and are necessary to enhance cybersecurity and control digital infrastructure access. CEO Jamie Dimon stated, "If you want to access our infrastructure, you should help pay to secure it." But fintech firms are pushing back. Critics warn the move threatens consumer choice and may restrict access to budgeting apps, digital wallets, and robo-advisors that depend on open banking data. Both the Federal Trade Commission and Consumer Financial Protection Bureau are now reviewing the policy under antitrust and consumer protection frameworks. Internationally, JP Morgan faced a legal setback in London, where a UK High Court blocked its €916 million lawsuit against directors of Greek FinTech firm Viva Wallet. The dispute stems from a contested call option in JP Morgan's acquisition deal. The court ruled that JP Morgan's attempt to pursue parallel legal action in Greece and the UK posed a risk of forum shopping and legal uncertainty. Elsewhere in regulation, the U.S. Office of the Comptroller of the Currency released long-anticipated guidance confirming that federally chartered banks may offer crypto custody and stablecoin reserve services, provided they meet capital and risk standards. This opens the door for traditional banks to securely enter digital asset infrastructure with full regulatory backing. On the infrastructure front, the Monad Foundation acquired Portal, a startup focused on stablecoin integration for Web2 companies. The deal will support turnkey solutions for cross-border B2B payments, further linking traditional commerce with blockchain rails. Despite the bullish sentiment, concerns around illicit crypto finance remain. A Chainalysis report estimates that over $21.8 billion in cross-chain illicit activity has occurred in 2025 alone, including through anonymized wallets, DEXs, and smart contract protocols. Analysts warn that enforcement and real-time analytics, not just regulation, will be key to protecting digital finance as it scales. Finance segment wrap-up. Bottom line, the Genius Act is now law, and it's not just symbolic. It's already triggering capital flows, institutional adoption, and a reset of the crypto finance relationship. But that momentum collides with new power plays, from JP Morgan's control over data pipes to executive branch ethics scrutiny to global legal pushback. As the industry pivots from experimentation to execution, one thing is clear: the future of money is programmable, and it's happening now. Now, let's move from markets to innovation. Here's your tech update. AI fraud tools, Apple Wallet expands, and Microsoft's bet on super apps. Let's turn to the world of tech, where artificial intelligence is rapidly moving from innovation to infrastructure, powering fraud detection, banking tools, and enterprise software ecosystems. Across the industry, the race is on to consolidate user behavior, payments, and data into seamless, AI-first experiences. We begin with a breakthrough in financial cybersecurity. This week, Visa unveiled an AI-powered platform designed to preemptively stop digital payment fraud across its network. The new system, dubbed Visa Protect, integrates real-time data from banks, merchants, and telecoms to detect anomalies before a transaction is authorized. According to Visa executives, the AI engine runs over 1,000 risk models per second, screening more than 70 billion transactions annually. Initial deployment shows a 22% drop in false positives and a 30% increase in early fraud detection compared to legacy systems. With synthetic identity fraud on the rise, the system is already being piloted by major banks in North America, the UK, and Singapore. The launch comes as global losses from payment fraud are projected to reach $48 billion by 2027. Visa's move not only strengthens its network integrity, but also positions it as an embedded infrastructure layer in the evolving real-time payments ecosystem. Meanwhile, Apple is quietly expanding the reach of its digital wallet. A new update to Apple Wallet enables integration with payroll systems, ride-sharing credits, health benefits, and even real estate platforms. Users in California, New York, and Texas can now directly receive government disbursements, including tax refunds and SNAP benefits, into their Apple Wallet, bypassing traditional banks altogether. The update reflects Apple's ongoing pivot into financial services infrastructure. Combined with its BNPL offering and Apple Card, the wallet is becoming a hub for income, spending, rewards, and access, a critical move as the company eyes broader control of user data and in-app payments. Across the enterprise landscape, Microsoft is betting big on the next wave of fintech productivity. The company announced a strategic partnership with Plaid, aiming to integrate open banking APIs directly into Microsoft 365 platforms, including Excel, Outlook, and Teams. This will allow users to view real-time financial data, build live models, and automate workflows directly within their productivity suite. For example, small business owners can now reconcile expenses, trigger invoice reminders, or track KPIs using live bank feeds, all without leaving Excel. Analysts see this as part of Microsoft's larger super app ambition. By embedding finance into core software tools, Microsoft aims to build a financial operating system for SMBs and enterprise users, competing with Salesforce, SAP, and Oracle, but with a lighter, AI-driven approach. Elsewhere in the tech ecosystem, Stripe is doubling down on AI-enhanced developer tools. The payments giant released Stripe Copilot, a new GPT-based assistant that helps engineers write, test, and troubleshoot financial APIs faster. Built with OpenAI's enterprise LLM stack, Copilot has already reduced integration time for startups by over 40%, according to internal testing. The tool is part of Stripe's broader push to become the de facto financial infrastructure for the internet, not just processing payments, but building embedded financial experiences across apps, platforms, and marketplaces. On the hardware side, NVIDIA continues to extend its dominance. The company revealed a new AI accelerator chip optimized for real-time trading algorithms and automated compliance screening. Early tests show a 46% performance improvement over previous models in financial analytics benchmarks, making the chip highly attractive to high-frequency trading firms and financial surveillance providers alike. Industry analysts say this could further entrench NVIDIA's position not just in AI, but in FinTech infrastructure, as banks, hedge funds, and regulators increasingly rely on AI hardware to power their decision-making engines. Meanwhile, Amazon Web Services announced a partnership with the European Central Bank's digital Euro sandbox, providing cloud tools and encrypted environments for Eurozone central banks testing programmable currency functions. The initiative is expected to inform the final design of the digital euro, particularly on privacy, transaction limits, and interoperability with DeFi. In the private sector, Revolut launched a new feature called Finance Home, a personalized dashboard combining investments, budgeting, lending, and crypto into a single, AI-curated interface. It's part of a growing trend among neobanks to offer hyper-personalized, all-in-one money experiences. And finally, Robinhood announced it will roll out Pulse, a real-time sentiment engine for retail investors. Pulse uses AI to analyze earnings calls, Reddit threads, SEC filings, and even TikTok finance videos, assigning sentiment scores to stocks and ETFs in real time. It's a move that blurs the line between social media and stock analysis, giving users an edge in detecting momentum trades and avoiding hype-driven volatility. Tech segment wrap-up. Bottom line, artificial intelligence is no longer a feature, it's the foundation. From Visa's fraud defenses and Apple's wallet expansion, to Microsoft's API-powered spreadsheets and Robinhood's TikTok-powered sentiment engine, tech giants are turning finance into infrastructure. As every platform races to build real-time, intelligent, and embedded experiences, the next decade won't just be digital, it'll be decisively AI-native and invisibly financial. Let's bring it all together. Here's your final recap and call to action. And that wraps up today's breakdown. From the Genius Act reshaping U.S. crypto law and J.P. Morgan's aggressive data strategy, to Apple's expanding wallet and Microsoft embedding finance into Excel, one thing is clear: the future of finance and technology isn't just arriving, it's evolving right under our feet. Whether you're navigating new regulation in crypto or building tools for real-time digital payments, staying informed is your edge. If today's deep dive helped you see the market a little clearer, don't forget to like, share, and subscribe. And tap the bell so you never miss a beat. Drop a comment below. Do you think stablecoins will replace traditional bank payments? Or will the big banks find a way to stay in control? And remember, this is FinTech Matrix, delivering money, tech, and trends to your doorstep. Thanks for watching, and we'll see you in the next one.